Well, good afternoon, Maverick traders. Welcome to the Market Roundup. Joe with you here on a Wednesday. It's the 19th of March. Let's jump into the market action. I'm going to take a look at some of the news of today. We're going to look at things technically, and I've got a couple of trades that we can share.
Disclaimer. This video was created for professional stock and option traders. Maverick Trading is a proprietary trading firm that employs professional traders around the world. Our traders trade firm capital and keep 70 to 80% of profits they generate. All trades and analysis in this video are for professional traders only. If you are interested in becoming a professional trader for Maverick, click the apply button in the video description. Let's break down what happened today.
Moving into the market analysis, folks, you could see that we had a bounce, and it was pretty much led by the FOMC statement. Let's jump straight into the daily news. So we did have a bounce, and it put it back into this area, or I should say back to an area where it can linger around to some key levels. We'll get there in a second. The FOMC comes out, makes their statement, says, hey, we're going to keep rates unchanged. We like what's going on. We saw the CPI go down, the PPI go down last week. Starting to see retail sales get a little slower. And that is actually great signs. However, if you take a look at what's going on in the economy with the tariff worries, all of a sudden, oh, geez, maybe this is not such a nice slide lower, but maybe just a cliff, everything's going to fall off. And I think that might be some concerns. However, the Fed did say, hey, we still see two rates coming. We've got the data coming out that would actually support that. So I think the markets took it as, hey, that's great. And we had to move higher. Now, towards the end of the day, folks, you'll see that we actually kind of slid off of those highs. And I think it's because of the sentiment as of late. So let's just get straight into how we finished. The Dow about 1% up, the S&P over 1%, Q's up 1.5%, Russell, everything bounced. And oil's still up a little, gold's up. So it was just kind of a general buying surge overall. Now, if you take a look at the advanced decline line, 74%, 23%, that supports it. Take a look at the above below 50-day moving average. I mean, obviously, it's going to take more than one day to push some of those stocks back above it. We're still 65.35 to the bear side. Let's get straight into the chart, because what I wanted to kind of lean towards was what I noticed towards the end of the day. So the Fed comes out, and we did. It was an absolute, it was actually during the statement when Powell came out and said that, hey, we're right in line for the two rate cuts. He sees things where they're at, in light of, we know that there's some tariffs, so on and so forth. But right towards the end of the day, a little bit of a drop there. Now, I zoomed this chart out because it happened to be at a pretty interesting level. That's right, this area here. So I call it lingering around this area. So we gapped up and we ran higher. The volume a little bit higher than it was the previous day. There's just not enough in there for me to make another decision. And for me, it feels more like an oversold bounce or a profit cover or a profit-taking rally, more so than it did, hey, this is a good place to maybe stabilize and turn things around. So I imagine this is at best just going to kind of stay foggy up in this area over the next little bit. If not, I would not be surprised if we turned right around. Now, things can change based on whatever announcement comes and whatever tariff change happen. There's plenty out there to make things a little spooky. But where we're at right now, there's no real confirmation of that next rollover. Moving to the Qs, pretty much the exact same thing. I kept this zoomed out so I can draw that same line, a little bit rougher here, but it's still back up into at least touching these areas. Things I didn't like, that volume was pretty low. The shadow, once again, that we're during off the highs of the day, towards the end of the day, we closed higher, but well off the highs. And with that light of volume, this wasn't a real round of purchasing more than I think maybe just people stopped selling or even some profit taking on the short side. That's my 2 cents. Now, that's not going to change my outlook because it hasn't changed from yesterday. We're just going to still stay at that -2 for now. But take a look at our heat map. And I expect all this to be green with a big surge, a big bottoming factor. But it's not that way. We got Intel. I think it had some news. PGR did as well. There's some dark red in here. But take a look. Consumer defensive slipped a little bit. Everything kind of got a green to it. If you take a look at a lot of these charts, these green candles didn't make too big of a difference in the overall patterns. So we would have to see 1 or 2 days like this for things to really flip over. So that makes it pretty easy on where my outlook's going to stay or change. And the word is it's not, it's going to stay. I was at -2. We talked about maybe going to -3 with another confirmation of this beautiful bear rally. But today's candle was more of a hiccup, more of an event that the FOMC came and saw some positive numbers and spun some positive things. I mean, in light of what is going on, this would be perfect. If the markets were kind of flat and there were no tariff worries, these numbers are exactly what the Fed wants to see. However, these numbers now can get much, much worse. So I don't quite believe in this candlestick yet. Now, if I see a couple more move higher, increase in volume, I see some things flip around, well, we got something else to think about. So I'm still going to stay at this outlook, and I will be looking more towards the bear side if I get opportunity. That being said, let's get to it. Now, we've been talking a lot about ETFs, and I still believe in those. I think that the ETF is probably the cleanest way to trade right now. It's not as muddled, it's not as reactionary or volatile, but I figured it'd be fun to take a look at a day like today and compare it to what we've seen over the last week. So the strongest and weakest sectors over the last little bit have been, well, utilities and energy are the strongest, and communication services and consumer cyclical have been the weakest. So I said, okay, let me go through these and see what I can find. Now, once again, folks, for every great trade I found in that sector, I found horrible ones as well. So I decided, hey, here's the top here. You got Chevron, AIG, you got CME and ICE, right? I've got two exchanges, the Chicago Mercantile Exchange or the CME Group and the Intercontinental Exchange, ICE, and they're doing well. And then on the downside, we got Reddit, right? We got BCE, which is a Canadian communications company. Meta, you know that. Etsy, which was a darling. In fact, that's a chart we'll look at. GPK, it's a packaging company. And then we got Home Depot and Lowe's. Now, these things have been weak, and they've stayed weak, and they continue to be weak. So let's jump into our first chart. This is ICE. The CME is actually just more of a straight angle here. ICE actually took a little bit of a pullback, which is why I like this high base. So something sideways to up. The volume's light, but this didn't really fall apart or crash or react over the last little bit like the markets have. It's just slowly building. So I thought that was interesting. Not shooting for the moon, but maybe a good +1 trade in there. Going straight down to the bear side, here's Etsy. Etsy continues to slide. It continues to bleed. A lot of these look like that. Reddit looks like this. Home Depot looks like this. Lowe's looks like this. The problem that I have with individual stocks, and this kind of reinforces why maybe we play conglomerates or ETFs, is when these things bounce, they bounce very, very hard and very, very quick. It's almost like you'd see the opposite in a bull, right? Bullish has these very aggressive corrections, but they're very short-lived. Well, this is a very classic indication of bear. So if you are, hey, you know, Joe, I'm going to do the 45, 42.50. That's great. Well, this thing could easily be up here in a week, right? And then be right back down here the next 3 days. So these are very difficult to trade. And that's kind of what I found with most of the traders I've been working with as of late, is the timing is very difficult. You either got to be super wide or you got to have that timing just about perfect when you're playing some of these beat down stocks that continue to go lower. It's just when they bounce very aggressively. So I figured that would just be something interesting to talk about. Maybe you guys have come across it yourselves. So overall, guys, so the stock market, it does remain volatile, and we are seeing more selling than buying. Obviously, Joe, since the beginning of the year, we're lower than we started. Yeah, it's very difficult to identify them. They sell long and slow, and then they retrace very quickly. So it's the bounces, I think, that frustrate most traders than I'd say the overall identification of weakness. Keep that in mind, because you don't have to really make those trades until something's more clear cut. Maybe a longer correction. If we could get 2 or 3 days like today in a row, 2, 3, 4 days of an up move and then a rollover, we'd have a much easier time finding sustainable bear trades. So today's FOMC statement created a surge in the markets. I'm going to keep it as that. I don't think there was anything that the Fed thought was super special. I think it was just an excuse to maybe short cover. But we'll see how that plays out. So be super technical. FOMC keeps rates unchanged. We know that. We have jobless claims and leading indicators coming up. If that jobless claims numbers start to really surge or increase, we could see that impact of the tariff worries and the true fear of sentiment is starting to roll over. And maybe some of those federal layoffs are going to create that. Now that just creates that snowball effect. That's where you get the rollover and the breakdown to the next lower low. Much easier to identify a bear move. Earnings season, folks, I think we're on our way out. Check possible trades, as always, if you're trying to avoid them. Cash is a position. It's been a kind of a fun market to watch, but a little harder to trade. So be patient. Thanks for joining me, folks. We'll talk to you next time. See you later.